Good afternoon, friends. It's such a delight to be back with you all again. This is an event, IMC Chamber of Commerce and MCX. We are doing this event jointly. And as you know, every time we come up with a new theme, this time the theme is on investing in indices. Index investing is something we are going to be talking about. But before we get going, I want to invite IMC's president, Anand Singhania, to deliver his presidential welcome address. As you all would know, he hails from that, a very popular, famous Singhania family. With I think he's probably the 5th generation entrepreneur from the Singhania clan. And it's such an honor for the chamber that is accepted to be the president of IMC this year. President, sir, over to you.
Thank you, Mr. Chandrasekhar. Thank you for your opening remarks. I have not accepted. I was elected, so I'm very happy to be here as the president.
That's right.
Of the IMC chamber, and I've chosen partnering for growth as my theme. So I see this wonderful platform to really partner with MCX, where we are having this joint webinar. So with this, I wish a very good afternoon to all the participants and speakers for this event on the jointly held with the leading exchange MCX. So IMC has the unique distinction of being a SEBI accredited training institution for commodity derivatives. We conduct a large number of events every year to spread awareness about commodity markets, as well as train and educate value chain participants. We recently celebrated 75 years of independence. Let us remind ourselves, investing with knowledge is a way of financial independence. As they say, earning is less difficult, but making the money earned for one's demands attention. Currently, there are many avenues for investors to invest their money: fixed income, bonds, debts, foreign exchange, real estate, etc. In recent years, commodities too have also become an asset class. There are several commodity-related investment products. One of them is the index, a structured product. Commodity index aims to provide a reliable benchmark for a specified commodity group, say precious metals. It is hence recognized that inclusion of commodity derivatives in any investment portfolio enhances the risk-adjusted returns. Similar to equity indices, commodity indices can be traded on exchanges. Commodity indices provide a simple approach to getting exposure to this asset class. If accessed with a well-regulated and transparent financial instrument, it can provide investors with safe and decent returns. Globally, investor interest in commodities is rising. As all of you know, commodity prices have gone through the roof, and the platform gives you a chance to be a part of the highs and lows of every investment cycle. I'm reminded of an old adage, don't put all your eggs in one basket. This logic obviously applies to investment too. It is not wise to club all your investments, but to diversify them in various asset classes. Our expert speakers today will share with you and us, their views on the importance of diversifying the investment portfolio by investing in commodity derivatives. Once again, I welcome the speakers. We have Mr. Vikram Dhawan, Head of Commodities and Fund Manager of Nippon India Mutual Fund. We have Mr. Vineet Singh Kaler, Senior Manager, Training and Education from MCX. And of course, we have our own Mr. G. Chandrasekhar, the Economic Advisor to IMC and Director of IMC ERTF. So before I conclude, I'd like to say a few words about IMC. IMC Chamber of Commerce is a premier institution dating back to 1907. We have over 5,000 members, and through our associate members, which are about 150, we have a reach of about 400,000 businesses across various sectors of industry and trade. We have several expert committees which provide policy inputs to the government both at the center and as well as the state. And we continuously interact with the policymakers at various levels. We organize dialogues, workshops, seminars, conferences, and several other initiatives to add value to all our stakeholders. And we bring out policy papers and white papers, which we present to the government, which are heard. Very recently, our representation on export credit risk assessment was accepted and received by the Commerce Ministry as well as the ECGC. And there was a much higher credit available in terms of percentage cover, as well as the cost of capital was reduced as a result of our initiative. The Chamber is now a cradle for nurturing young talent. It promotes gender equality through its IMC Ladies Wing and its Young Leaders Forum, which has become an embodiment of youth, enterprise, positivism, and movement for women empowerment and entrepreneurship. With this, I thank you all for joining this very interesting seminar. I'm sure there'll be a lot to learn and understand of the art of investing in the indices. Thank you.
Thank you. Thank you very much, Mr. President, for this very warm welcome speech. Wonderful. I'm sure you'll be happy to know MCX and IMC have a fairly long relationship. We've been working together for the last several years. We do several events every year, almost probably 6 or 8 events in a year, even occasionally 10 to 12 events. And this relationship has stayed very healthy, very robust, and it's evoked a lot of interest in the commodity amongst the value chain participants. Therefore, I think we are again delighted to host this event along with MCX on investing in indices. Friends, if you give me a moment, I just want to share screen. I have a short presentation to make, but yeah, okay. Yes, here it goes. Slideshow. All right. As our president rightly observed, IMC is a SEBI accredited training institution for commodity derivatives, and in this capacity, we do a very large number of events for all the value chain participants in the commodity ecosystem, covering energy products, covering base metals, precious metals, industrial metals, agriculture commodities, etc. And this is a part of that initiative of IMC. We work with MCX, and today's webinar is on investing in commodity indices. So let's straight away get into the topic. Now, SEBI, the Securities and Exchange Board of India, is a market regulator for equities and, of course, commodity derivatives. And SEBI recently took several initiatives to deepen and widen the commodity derivatives market. SEBI has allowed introduction of new products. SEBI has allowed participation of new participants. SEBI has allowed new services to be launched. For example, mutual funds are now allowed to trade commodity derivatives. AIF 3, category 3, alternate investment fund category 3 are allowed to invest in commodity derivatives. Eligible foreign entities are allowed to trade commodity derivatives. Portfolio management service has been allowed. In terms of products, options trading has been allowed, which was actually banned until about 3 years ago. And that ban has been lifted. Options trading is allowed. We have both options on futures and options in goods, I think, which is very important and very interesting. And of course, we have index trading. And today we are going to be talking about index trading. Okay? Now, what is an index? As our president pointed out, an index is a structured product. Okay? And the purpose of this index is to provide a reliable benchmark for a specified group of commodities. Okay? a group of commodities can have several individual commodities in the same basket. For example, you take precious metals. You can have gold, you can have silver, you can have platinum, you can have palladium. Okay, right? And then you can have a precious metals index for precious metals. Similarly, you can say look at base metals, for example. Aluminum, copper, zinc, nickel, tin, lead, all this can come into one basket, and we can evolve an index to trade all that together as a group. And therefore, we can have a basket of diverse commodities or a basket of a group of related commodities. Okay, so index allows all these possibilities. Now, commodity index is primarily based on futures. Okay? And therefore, because it is based on futures, it is extremely necessary that the underlying, there is enough liquidity required for in the underlying derivatives, which is important. The underlying is the physical cargo. Futures is derivative. Therefore, we need enough liquidity in the futures market as far as that underlying commodity is concerned for the index to perform quite robustly. Okay. Now, commodity selection and weight are usually based on the production value and traded value. Of course, you can club disparate commodities into one group, but there has to be a certain logic in doing that. For it primarily, it has to be based on production value. You cannot have it would be unwise to have an index for narrow commodities or commodities whose production value is very low. So usually, index is based on production value and the traded value. That is also extremely important. And and we have obviously value weighted index. I'm sure you understand when I talk of index, when you look at Sensex, for example. What is Sensex? It's actually BSE has brought together several shares of several companies and created a basket of those shares. And then you are able to invest in Sensex and benefit from the volatility or up and down movement of Sensex. The Nifty, for example, is the same. And therefore, that's how indices are created. Now, index trading also allows you continuity. What is important is near month contract. When the near month contract expires, it allows you to roll this over into the next month. And therefore, there is a continuity and seamless extension of the contract. And how is the price calculated? It's absolutely real-time price calculation, because when you have 4 different commodities in an index, these 4 different commodities will move. Their prices will move in probably different directions, but the index will calculate all those changes on a real-time basis. Tell us how the average is moving up or down. And also this calls for periodic rebalancing, because we've seen in Sensex, for example, some shares exit from that basket, some shares are added. Okay, shares of some companies are included, and shares of some companies are excluded based on their trading volume, etc., etc. And that's how the rebalancing takes place. And this rebalancing is done periodically, depending on various factors. Commodity index is no different. It's the same. There will be periodic rebalance. Now, when we invest in index, there are several advantages. One most important advantage is, of course, portfolio hedging. You can hedge your portfolio. It provides a great opportunity, because when you have exposure to several different commodities, or even if you don't have exposure to the underlying of any commodity, you want to invest in one which represents all those underlying commodities, then index is a great opportunity for you to invest. Similarly, it allows index and investment in index allows you allows all the market participants to trade and take a view of the overall market. If you don't want to take a view on gold separately, silver separately, platinum and palladium separately, but when you trade the index, it allows the trade, the investor to take an overall view of the market. Okay, and then of course liquidity. Liquidity is most critical as far as index trading is concerned. The success of index futures is concerned. So index futures tend to be more liquid than even its components, primarily because they are very popular structured products for investment purposes. And of course, it's cost effective, easy to trade. For example, again, just going back to the equity market, Sensex or Nifty, the cost of trade obviously will be much less than for individual company shares, etc. And therefore it does not require much of an application of mind or a deeper study to invest in an index. When you do it, invest in individual commodities or individual company shares, you need to do a lot of study. But an index actually represents a wide spectrum of shares or wide spectrum of commodities, and therefore it becomes cost effective, easy to trade. It has low volatility, unlike individual commodities. The volatility is low. The risk in investing in index futures is low, and it's of course low margin trade. In fact, the point is, commodity markets are generally volatile, but the components of the index, not all of them may be highly volatile. Some may be less volatile, some may be more volatile, and therefore it would actually get nullified or adjusted, and that is how it is also low risk, because in our country we are in an expansionary phase, and therefore our growth is going to be substantially commodity driven over the next 15, 20, 30 years. And therefore commodity prices will keep rising. We'll produce more, consume more, trade more, and therefore the index hopefully will keep rising secularly over a period of time, with of course adjustments from time to time. And these are great advantages of investing in index futures. This is exactly where MCX indices make a tremendous amount of commercial sense for investors. Now, the index futures of MCX that would actually enable institutional participation, like mutual funds, for example. Quite apart from, of course, investment by individuals, high net worth individuals and retail investors, it also would enable institutional participation. As I said earlier, mutual funds, AIF category 3 can trade commodity indices. There's no hassle of delivery. When you do physical, if you're in physical trade, there is always, you need to give delivery or take delivery. Even in case of futures, if you don't square off your position before the due date, you will be there will be compulsory delivery, give or take delivery if you don't square off your position. Therefore, whereas in index, there's no hassle of delivery at all. And interestingly, MCX has what is called the ICONDEX. It's a series of commodity indices. It comprises, of course, 2 sectoral indices, bullion index and base metals index. And it also has 4 single commodity indices. Obviously, I'm not going into the details of all this. I'm sure Vinit from MCX will explain what these are and how they would benefit investors. Now, with this, I will conclude my presentation, but I'll be available, of course, till the end of this event. I usually issue a disclaimer. I am not a trader. I don't hold any trading position either in the physical market or in the derivatives market. I'm a student of the market. I'm also often a teacher of this market. Therefore, with this, let me say good luck. God bless you all. Happy investing. And I would now invite our friend, expert Vikram Dhawan, to share his thoughts with this very august audience.
Thank you very much, sir. And good evening, everybody, and thank you very much for joining in. My name is Vikram Dhawan, and I'm Fund Manager, Head Commodities at Nippon India Mutual Fund, and I manage the gold, silver, and the multi-asset fund. I'll try my best to make good use of this time for all of you, and I don't have a presentation because I'm sure my friend Vineet from MCX will be showing you all the slides about indices which MCX has. So I didn't want to duplicate that kind of a presentation. So why index? Why commodity index? Why any index anyway? Why should we even think about index? Whenever we talk about stock markets, or commodity markets, we are talking about individual commodities like gold or silver or copper or crude. Very rarely you will see an animated discussion about index going up or index going down, in the commodity space at least. So it's like this, that index is a market. So let us say if you take the broader indices that we have in this world. Obviously, MCX also has ICOMDEX, which is a broad index of commodities. Then you have the Reuters ex-Reuters index, which is the CRY index, and then you have Bloomberg index, and you have the Goldman Sachs index, and so far and so forth, which have commodities from oil to cotton and from silver to copper. So an index is a market, and whenever you're investing in an index, so you are assured of market returns. So it's like this: if it's an Olympic, then if somebody beats the market, he or she gets the gold medal. And but if you don't beat the market, you'll either get a bronze or you get no medal. But when you are trading or investing into index, then you are assured of a silver medal. So depending upon how risk averse and what is your objective and philosophy of investment is, that whether you always want to go for a gold or you are very happy to have silver, medal all the time. So that is the reason why indices are there, and that is why investors do have an affinity towards indices also, and also the individual commodities. One of the best way to describe an index, obviously, Mr. Chandrasekhar did mention that it is dependent upon the either the global consumption or the global production. But I think the most important thing whenever an index is formed is based upon the its effectiveness in the portfolio. For instance, let's say in a country like India, which is short of oil and gold and silver and so many other commodities, an index having these commodities is of value to the investors. But let us say we are surplus in bauxite or zinc or manganese. So any index which has all the surplus commodities, they may not be an sort of interest in that. So investors, or rather the flow of money or investor interest will always come in those indices which provide a solution for an existing problem. So the problem that we have is that we are a net importer of most commodities, especially oil, etc., gold also. So what is the solution for investors? So today, oil prices are back above $100 per barrel, and it will have an impact on the inflation and everything in the country. So is there anything that I can do in my portfolio to diversify that risk or hedge that risk, or is there any index which I can buy, which will give me some sort of a protection to against this kind of a move in the market. So that is the other thing. The most important thing which the investors should keep in mind is the relative valuation. Now, obviously, I presume that most of us over here do understand, equity indices, Nifty, etc. So let's take the example of Nifty, which has got 50 stocks, and whilst the market may move 10%, but not all the stocks will move up by 10%. Some will be moving more than 10%, some will be moving less than 10%. Either because of sectoral differentiation, or it could be that they are from the same sector, but what we call as relative valuation. Same set of number and same set of news will invoke different reactions in two stocks. Similarly, same set of macro information will have invoke different reaction in different commodities. For instance, tomorrow there's a war, then oil and gold may go higher than let's say silver or maybe copper or aluminium, etc. So this is what we call as relative valuation, which keeps on fluctuating. Now, for a retail investor or for an investor who's not fully invested into or engaged into managing his or her or his portfolio, it is very difficult, even for active fund managers like us, for us to keep on top of this changing, fluctuating valuations of each commodity and each security and each equity or bond. For us itself is a challenge with all the infrastructure and the teams and everything that we have, information we have. So it becomes even more challenging for somebody who's completely disconnected from the live market or the live feed or the live analysis, etc. So what an index does is, for instance, let's say you want to buy the energy index of MCX, which has got natural gas also and crude oil also. Now tomorrow, because of some change in fundamentals or change in news or whatever, the gas prices or oil prices may not move in tandem. One may outperform, the other may underperform. But what it does is that instead of you making a choice whether I should be fully invested in natural gas or fully invested in crude oil, or let's talk about the gold index. Now, there is a situation in which there will be instances where gold will outperform silver by a mile, and the reverse also happens when the silver tends to outperform gold. So again, to get an alpha or to get the gold medal, as I said earlier, in an ideal world, you may want to be investing in silver when it is outperforming gold, and you want to be in gold when it is outperforming silver. But how do you find out? Again, if you have some conviction or some model which can predict it, share it with us also. We'll pay you money for that. But I was just that was in a lighter way. But I think these things are very difficult to predict, and even more difficult to execute and act upon. You may know so many things, but to put your money where your mouth is also another thing, because the biggest challenge in the investment world is that we all know so many things, but whenever the event happens or volatility comes or whatever happens, how many of us are actually able to follow through in that? So that is where institutions like us, which are very structured and very process driven, we would always have, irrespective of what our emotions are saying, we will have a processed way of investing. So if you have that kind of an investment protocol, then maybe you can take this kind of a risk. Otherwise, if you have both gold and silver in the index, then irrespective of which one is outperforming or underperforming, you will participate at least to some extent on the upside. So let's say the gold is rallying or silver is flat, or silver is rallying and gold is flat. If you have both on your index, so at least something will pull that, give you the positive return. So that is very important, the relative valuation, and it works very well. The bigger the index, let's say tomorrow if M6 were to come with an ICOMDEX, they have an index in base metals which have got base metals, 5 or 6 base metals. And we have been an investor in that as a fund house. So, it may happen, and it has got copper, aluminium, lead, zinc, and nickel. So it may happen that, nickel may rally more than copper, or copper may rally more than lead, or zinc may rally less than aluminium. But if you have a sectoral view and if you invest in that index, uh, at least some upside you will get, or you'll be able to participate in the upside of the sector, if not the individual metals. So this is a very important aspect of why people hold index. And same for Nifty also. You may be bullish on pharma, you may be bullish on IT, and you may not know where to put more money or less money, or you may be bearish on certain sectors like banking or commodity or whatever. But you don't know whether your conviction is right or your call is right or not, so you buy an index. So if the country is moving ahead, the economy is moving ahead, the index is also moving ahead, so you participate in that. Perhaps in a hindsight you would have bought let's say if last year, if in the next 3 months, if let's say for instance IT outperform, I'm not giving a call being from the fund house, but let's say in the next 3 months if IT outperforms by every other sector, then obviously in the hindsight it may appear that I wish I had put more money in IT, but since IT forms part of the index, you will get some upside. So that is a very important aspect of the index. The other issue is timing. You may be bullish on, let's say again, to give you an example of a major index like an ICOM index or whatever. So which has got all the commodities from oil to cotton to silver and gold, etc. So you may be bullish on commodity per se, but you may not know that which commodity to time at what period of time. So it's like maybe this is the right time to buy gold, but maybe you need to wait for zinc. Maybe you need to wait for aluminium, so far and so forth. Maybe cotton, you should have bought it yesterday. So, this kind of dilemma, this kind of investor dilemma, which you will face in everything, whether you're buying a bond index or whether you're buying a equity index, is that, which sector to buy or which commodity or which security to buy at what point of time. But in an index, the timing thing is taken care of because everything comes to you together. So even if you have been, missed the timing of certain sectors, at least the places where you got the timing right, they will give you an upside. And always, it always happens, that you will never be able to predict the bottom or the top. But if you're sitting with an index, and if the market moves from X to Y, I'm assuming X is low and Y is higher, then the index will participate to a large extent, sometimes even more than, depending upon what is the normality of the market. So that is another thing. It takes out the timing piece from, instead of making your own basket of securities, having 10, 20, 30 securities having with you, you can always buy an index in which, you don't need to worry about timing. So if let's say base metals are rallying, so you get some upside, and after 3 months precious metals rally, then you get some upside, and that is how your investment will grow, as the case may be. And also, if you get it terribly wrong, it's like you entered into commodity as the worst time, or entered into equity at the worst time, then since it is diversified, it will ensure it will soften the blow. So you can see that more often than not, the fall in individual stocks is a lot more than the fall in the index, especially the ones which are falling out of favor. So in a situation where your portfolio has got those commodities or securities or those equities which are fast falling out of favor, so you'll get a lot more cuts in that. Whereas if you're buying an index, then most of it will be sort of quite a bit of it will be diversified, and the blow may not be huge. So it's so at the same time, index doesn't permit you to get that gold medal in investing, but at the same time, it also protects you from not losing a very large amount of money vis-a-vis buying individual securities. Obviously, Sam, the best way to look at indices is to have a sectoral play. If you're bullish on commodities, and buy the diversified commodity index. So even if 2/3 of that complex rallies, and you can make decent money out of it. if you're bullish on the base metal index, then you can buy the base metal index. If you're bullish on energy, you can buy the energy index, as the case may be, so far and so forth. So these, these are ideal. Even in equities, also you would have seen there is an IT index, there's a metal index, and there's a broad overall Nifty index. Let's say if you're very bullish on equities, you buy the Nifty. If you're specifically very bullish on a sector, you buy that metals and you buy the metal index and equities, whatever, as the case may be. So that it is a very sort of a good way, a very well, nothing is safe in this world, because investing is all about risk and return. But I think it is a more cost effective and more a bit low risk. As I mentioned, there is no zero risk in our feed, but it is relatively lower risk way to invest into the sectors. Also, I think the one other thing which you need to note about index is that most of these indices they go in for periodic rebalancing. So, for instance, we have a commodity. Let's say if you have a metal index which has got 5-6 metals, and which is based on certain assumption, let's say consumption or demand in the country. So as the demand and consumption changes, the index also gets realigned. Also, since each index will have a particular allocation to a particular commodity, so as and when it's in a way that really works in favor of the investor in the longer run. So if you have a strict allocation in an index, so whatever security goes up, increases, you have to sell some shares to bring it back. Whatever security goes down, you have to increase the allocation. So in a very passive way, you are actually buying stuff which is getting cheaper, and you're getting rid of the stuff which is getting more expensive. So this sort of nets off your risk in the longer run. I mean, in an ideal situation, you should be buying stocks or commodities when they're at the bottom, but who gets the opportunity and who has the view? But the index does it for you. The more they will fall, more, let's say it's got 5 commodities or 10 equities or whatever is the composition of the index. So the more which any component falls, you have to buy that many units of that to bring up the value to the same level. So yeah, so there's lots to discuss about indices. I'll take a pause over here, and I will. I know it's almost 4:45 and close to the close of office for many of us. I leave the discussion over here, and I will pass on the baton to Mr. Chandrasekhar, who can then invite the next speaker. And then if you have any questions, I'll be very happy to answer them. Thank you very much.
Thank you, Vikram, for this wonderful exposition. I think you mentioned so clearly that investing in individual commodities or investing even in individual company shares requires a certain amount of research. Whereas when you invest in an index, I think it's a lot more easy. So like ease of doing business, I think index create for you ease of investing, and that's why I think it's extremely important. And you also said that different the components of the index probably would be moving in at different rates. The rates of change and prices will be different, but all that will by and large be offset. But secularly, I expect that commodity indices will become increasingly popular over the years, because our own countries, India as a nation, our exposure to commodities is going to be very significant. Our economic growth is going to be significantly driven by commodities, whether it is energy products or industrial metals, base metals, agriculture, etc. In some way, I think we are going the China way. Okay? We are not there yet. China's streets ahead of us in terms of commodity production, consumption, and trade. But I think our direction is very clear, because very substantially economic growth is driven by commodities. Okay, so Thank you very much, Vikram, but kindly stay back. I'm sure there'll be questions. We'll have a second round of talk after this. And let me now invite Vinit Kaler from MCX. He will share with us a presentation. He will take us through all those the details of these indices that MCX has launched and the various advantages and benefits of trading these indices or investing in these indices. Vinit, the floor is yours.
Thank you, Chandrasekhar ji and Mr. Singhania for starting with the keynote. It was very encouraging, and I mean, you have covered the complete ambit, Chandrasekhar ji as well as Vikram ji. It leaves me with some technicalities on the index front, you know, how indexes are there on the exchange. So I'll try and cover that in a presentation which I'm sharing. And then we'll take up any queries towards the end. So I hope you are able to see this.
Yeah.
See, as the session says, you know, investing in commodities through indices, it is very exciting to always hear about, you know, investing in commodities with new products. So indices relatively, I would say, is still a newer product which is gaining traction day by day. You know, the way ahead we are moving. So what do we really have on the exchange platform is we have, when you open the screen and you try and look at the prices or you toggle the website, you'll find many indices and values coming there. You'll find as a gold index or a silver index, copper index. You know, we might get confused. What is gold index and what is this bullion index? So let us just get it right. What we have here is we have indices running on the based on the current futures contracts, near month futures contracts of the respective commodity. Say, for example, a gold index, which would be called as a single commodity indices. It is a excess return index, which will be disseminated real time, continuous, and will reflect the movement of different month contracts, futures contract change. So that means the return on real-time basis in percentage terms, what we will see and experience in the futures contract of gold of 1 kg near month will be exactly seen on the gold indexes. Okay. For that matter, if you take any of the single commodity indices, so these are called as excess return indices. They take the daily real-time percentage return on the underlying futures as well as the rollover return when we move from near month to the next month during the rollover period of 2 days. So based on these continuous single commodity indices, weightages are assigned to them, and then we have something called as sectoral indices like Bullion index. It gets weighted average, weights assigned to gold and silver single commodity indices, and then the Bullion index value is coming. So everything is live running on the screen. You can monitor the underlying gold prices, silver prices. You can see gold and silver indices also reflecting the same percentage return. And then with the weighted index also coming in front of you. So we have 3 currently sectoral indices available: Bullion index or Bulldex or MCX ICOMDEX. Bullion index is representing gold and silver values. Metal index represent aluminum, copper, lead, nickel, zinc, and as the name suggests, energy represents crude oil and natural gas. We also are currently running a composite index wherein it gets representation from all the 4 segments on the exchange, but those are for only viewable kind of a state right now because derivatives on them are not allowed. All these indices here, they have a base value, starting value for December 31st. We started with 10,000 value for as a base value, and now they're running on their own current values depending on the market movement and adjustment which have happened over time in the market prices. So this is what we have open screen. But what do we trade on right now? Availability is futures on these indices, segment indices. So we have permission for Bullion index futures, metal and energy index futures. We have already received the details and guidelines to launch, make and launch the options on these indices, but that is under the construction process. We are constructing the contract, and that is in the approval stage. So very soon you will also both avenues available here. So all these indices, when we say they are weighted average, there are weights assigned to these underlying values or constituents of the indices. Like for MCX Bullion Index, gold and silver indexes, they have current weightage as 63.70. No, I don't go into all these 6 digits, but that is the weight assigned, and silver index has 36.297353. Now, these are 2022 weights. Correspondingly, you will see metal index, its constituents, aluminum index, copper, their weightages are also assigned. Now, these weightages are assigned once in a year based on the liquidity of the last 12 months of the derivatives, plus the physical market size, the availability of the product and production and other scenarios of physical product in the market with an average of last 5 years. And then we come up with new weightages. Now, these new weightages, we typically call them as rebalancing of index weightages. This happens on an annual basis, which we announce every year in the October, and they get applicable from the coming January month. So these weightages which are there for year 2022, they would have been announced in October 2021, that is 2 months prior to the actual ability of the index weightages. So these weights have actually got implemented in January month. Correspondingly, you will see these dates when these weightages were implemented. So the traders or market participants, they have enough time of 2-3 months. They are aware of what would be new weightages which gets implemented in January month. Accordingly, they can move their strategies and get their backend prepared, or their back for the new weights, and they are prepared. So from January, when the data are given and new weightages, they get applied to the indices. Now, this affair is done on an annual basis, whereas as compared to equity market, that is done on a twice a year. But in our case, it is only once a year, which we say as the annual rebalancing of which happened. Now, to just give you a glimpse, when I say it is the indices, single commodity indices, that I want to say is that on the real-time basis, whatever return the futures contract will be getting, say for example, there is a gold contract on the exchange of 1 kg, its near month is running at say 49,144. That would be the last traded price right now. I want to see what is the index value. So as compared to the yesterday's close, in this example, say it would be 48,955. Okay, with the current price, whatever is the the jump, the percentage jump, exactly same percentage jump would be seen in the index value. That is where we say these are exactly excess return indices, and they are continuous because we keep them rolling over before near month expires. Concept. Now, as far as the contracts on the exchange is concerned, these are as of now futures allowed on indices. I have all the 3 segments here on the same screen. So we have Bullion Index futures allowed to be traded with underlying as Bullion Index, which is called as Bulldex. Metal Index futures, they have underlying as Metal Dex. Energy Index futures correspondingly have the underlying as Energy Index. The trading unit for Bullion and metal is 50 times the index value, whereas for energy it is 125 times the energy index value. So when we multiply, we see that the values for an index which comes in are very small values as compared to if you want to take individual positions in the underlying futures contract. Say, for example, you want to enter into the Bullion side of the story, wherein you want to trade both in gold and silver, but you don't have expertise in both of them, or maybe you have expertise in one of them, but you want to trade in both because market scenario says that good returns might come to you if you trade in both. Maybe it would be a crisis situation or a pandemic, whatever, but you don't have expertise in both of them or either of them. So in that case, if you trade in gold 1 kg, the value comes at around, I have a slide for that, maybe the next slide, wherein gold value is running at 50,000 per 10 grams. So 1 kg futures will roughly be valuing around 50 lakhs. Whereas silver contract, if it is also running at 35,000 per kg, you know, roughly that the contract will also have some 50 value around that. So to be in these both gold and silver with futures, the value of exposure you are into is very big, and you may not be so sure of the movement of the assets because you are not confident and you are not having enough information. This is taken care by bullion index futures, wherein the risk is neutralized. It is a smaller product in value, and you get a chance to trade in the segment as a whole, which you intended to do in the first place by entering into both gold and silver. Suppose I want to be into the base metal segment. I'm having expertise of aluminum, but I don't know what is happening in copper, zinc, lead, you know, for example, but I want to trade. So metal index future becomes one of the obvious choices because risk is less and products are smaller in value. Plus, when we trade in these indices, these products are cash settled towards the end. I'm sure you would be knowing gold and silver, which contributes to making of bullion index. Metal index have representation coming from 5 base metals. These futures contract on expiry, they are delivery based. But once from these values are picked and indices is made, it is futures on these indices are cash settled. So it does away with the trading margin, delivery period margin, you know, that tension of getting product marked to you for delivery at the end is nowhere existing. These are all cash settled contracts. At any in time, you will find 3 contracts running, 3 calendar month contracts, monthly contracts running next to each other, and you can do n number of strategies and keep your products or strategies open till the last moment of trade. These contracts are available for trading in normal working hours of the exchange, that is from 9 o'clock till 11:30 in summers and 11:55 in winters. But on the expiry day, the contracts in index futures, they expires at 5 o'clock. All of these, whether it is a bullion index futures, metal or energy, they expire at 5 o'clock. On what basis? On last 1 hour weighted average price of the underlying constituent. So this is where, you know, some market participants and experts they try and be in some slice strategies whereby last 1 hour they try to capture that movement because products are cash settled. So that becomes more attractive for some of the participants. Position limits, you know, these are all parts and parcel as defined in the contracts, 10,000 lots and not more than 5% of the overall market OI member level, 10,000 lots or 15%. So these are all instrumental, which one has to be always aware of while trading. So the takeaway is these are smaller products with lesser risk and they are cash settled contracts. Now, let me just give you an example. When I say it was a smaller product, see, suppose I want to be in bullion side. I want to be in gold futures. It is 1 kg contract. If current prices are 52,585 per 10 gram, so contract value is 52.5 lakh worth. Okay, silver 30 kg is running at say price of 59,276 per kg. It was 17.8 lakhs worth of a contract. Now margins have to be paid upfront, you know, when you deal in futures. So if current margins running, maybe these margins are, you know, as per 12th of August 2022, I've taken backdated margins for reference today. So if I apply margins, my involvement of money in both cash with gold and silver would be around 6.86 lakhs. Whereas if I be in this bullion index, it is drawing its value from the near month gold and silver contracts only. So index value, if it is 14,578, then the contract value is around 7.3 lakhs, which is substantially lower as compared to the combined value of gold and silver futures. The margins are further lower because it's a lesser riskier product because it's in a weighted product which is running. So maybe 44,000 rupees is what gets blocked from the trading person's account, and he is with the same, overall segment of bullion side. And the advantage is this product is cash settled. Similarly, if I talk about base metals, let's not talk about all the values, but if I come to the value of the product, if you say 10 and 6, 26 plus roughly, this is a bigger value if I want to be in all these segments simultaneously. So it is easier if I pick the metal index futures contract and trade in them with a value of 8.7 lakh with lesser margin as compared to individual margins of the product. And what gets blocked from my account is 52,000 rupees, and I get exposure to all the base metals in a assigned weightage already declared by the exchange. And again, these contracts are cash settled, so you can keep all your positions up till end. This is a point of understanding here. Crude oil and natural gas are cash settled products on the exchange, but if you try and trade individually on them, the contract, in crude maybe is coming at around 7.3 lakhs and natural gas 8.7 lakhs with their margins. You will see around 5 lakh margin gets blocked when you trade both in crude oil and natural gas, even though the products are cash settled. So vis-a-vis, if you have an energy index futures running, so that contract value is roughly almost near to each other, but the involvement of money here is less in terms of margins. So definitely these products could be one of the products of choice. It's happening now and it'll going ahead, the futures and options and indexes will pick up like anything. What we see on equity exchanges, out of the total turnover, around 90% what I have observed is coming from index derivatives. The total turnover on the exchange, 90% is from index derivatives, FNO. So if this will pick up in coming years, you will also see, such kinds of volumes with futures and option on the exchanges happening through these index derivatives. Now, let me just go ahead. This is just for your reference. There is a very important point which I want to make. See, whatever is the index value, the contract size is multiplying the index value is coming like this. Generally, whosoever trades in the market, he feels that, the product in which I am able to turn my position quickly is the better one. So as compared, I've just taken an arbitrary example. If I take the round trip of buying and selling, and I've added the exchange fees and stamp duties and CTT all done. So if I be in the bullion side, my cost is coming at 132. That is also not relevant. The relevant point is the number of ticks in which I could achieve the break even. And profit and loss per tick was rupees 50 in bullion and metal indexes and 125 in energy index futures. So within 3 to 4 ticks, so add some whatever cost, brokerage or commission, whatever is there, within 3 ticks, any participants maybe in bullion side is able to achieve its break even and profitability. So that is significant. So you will see a lot of position churning and jobbing and such kind of trades will pick up and will be picking up in next coming months or years, when these products are more robust and more participation comes in. Just see, only 2 ticks movement is required, to break even in futures of indices. So this is becomes very encouraging. Now there is a question in everybody's mind: how do we map these movements? Very easy. If you understand gold and silver futures, you can map index movement. If you understand the base metals, you can map the index. So there is a relational trade which might happen. Say, for example, if we say that silver is not moving at all, gold has moved by 100 points, 100 rupees. So you will see 20.7 points movement, and the break even was within 3 ticks. So 20 ticks movement you could see on that bullion index. If I say gold is not moving and silver moves by 100 rupees, 6.3 ticks point movement is seen. And these underlying future contracts in gold and silver are such volatile products that 100 rupee movement, 200, 500 we have seen 1500 plus movement on many days. So So, it's the point, to understand that, how I could relatively see from the underlying products that what could happen in the indices. That could be one point of mapping. Maybe if I could take on a given day, if gold and silver both move in same direction by 100 rupees, the impact on index is 27 point movement. That is something important. Similarly, if I do the same analysis for maybe base metal side or energy side, I get to see some relations whereby I can define some trading strategies and be in these products in relation to what is happening in the underlying asset, because eventually indexes are getting their value from the near month underlying futures contracts. Okay, now one way of also looking this area is the Vikramji was mentioning, definitely, in different phases of market over a period of time, the products, they have different correlation with other asset classes, maybe Nifty. So this is one classic correlation for over a long period since index has been started computing from 31st December till date, till June. This has been the movement of different indices as related to Nifty. Overall, in these years, 5, 6, 7 years, it's been seen, generally these indices, they have low to negative correlation. Now, whenever you talk about portfolio investment, you talk about cross asset investment, products which have low to negative correlation generally are preferred because they tend to stabilize the returns and increase the returns in normal circumstances, and in crisis situations, they act as a savior for each other. I've just taken a small portion from that bigger graph. Okay, this is before pandemic. It is just for reference and explanation. I'm saying this before pandemic. Maybe I've taken period from August 19 till July 20. In that period, if I would have invested 100% in equities, I would have got a return of maybe 0.85%. That time equities were down with a risk of 31%. But at that time, if the indices would have been available and I would have just diversified myself by say 10%, 90% in equity and 10% in this bull dex, I still would have been better off in my return. From 0.85%, it got up to 5.2% with risk getting reduced to 28. If I further increase the weightages, 75 equity, 25 bull dex, substantial again return has gone up to 11%, risk is come down to 24%. And if I do a 50-50 kind of a thing, so where the return was 0.85, it could have been 22% and risk would have been considerably reduced to 19%, our ratio increasing with all the segments. Now, this is one of the example. I'm not taking any current market because, current market scenarios, we all are expert. We can go back and test the water, what is happening. I'm just giving you some glimpses. Now, this is during the pandemic, Jan 20 to March 2021, in a period of one year and 3 months or so. During this period, if we would have invested 100% in equities, my return would have been 20.5% with risk at 29%. Okay. But if I would have also invested diversified with say bullion index, which was available, so what would have happened? My returns at any stage would have gone up. So having asset classes, I want to bring in the point that having asset classes with negative to low correlation will always boost your overall return of the portfolio in normal circumstances, and in an adverse situation, it will act as a savior. So this is what I wanted to add, and that these indices and index derivatives could act like a good balancer to your portfolio, whereby they could add on to your profits by reducing the risk in a normal situation, and in adverse situation, they can even bail you out from the crisis. Now, this is what we have also observed that even bullion index futures, if it is running, it has a certain sense of correlation with the individual indices as well, gold and silver indices. So whereby you can relatively define strategies between gold contracts and bullion index futures, or maybe silver contracts and bullion index futures, likewise. So accordingly, if say gold index is moving, it has a 96% correlation with bullion index. So bullion index will also move in some direction, this is what I am just indicatively saying. Many people are doing this, which could be also leading to cross margin benefits or basket trading. These are the relations which people are picking up from the market analysis. Even we know that dollar has a negative correlation to commodities. So it is evident if we make a chart and see with index. So it shows a negative correlation with current over period, in last 7 years, it says negative 0.13%, but definitely in some phases or parts, you will find these correlations changing to more negative or to coming to zero or slightly low positive. Accordingly, we can define some strategies as participants. It is fairly easy to follow these indices. Just giving you a small hint or glimpse, like if suppose we know that indices, this single commodity index, they get same percentage return what you see on any gold or silver contract. Okay, futures contract, which is near month. So if I observe, all information is there with me. I know the weightages. I know a normal adjustment factor divisor for these indices. What I need to know is, if I expect say 1% improvement in both gold and silver prices, exactly same return will be reflected on gold and silver index. Those into values, gold index multiplied with the weightage, silver index multiplied with the weightage, add them up, divide by the divisor, you will get an expected Boolean index value. It's very easy to understand and follow these indices. So, since indices are available, we have seen encouraging average daily turnovers from market participants, which with enough depth and open interest, and which we expect it will go further and will be growing with the market interest developing in this area. So it will be a road ahead, wherein I said, like equity market, after of the total turnover, maximum around 85 to 90% is coming from index derivatives. So that could be one story in coming years, which will also be replicated or might be replicated here. This is what we expect. So overall, let me just sum up. Index derivatives are smaller contracts with lesser money involved, smaller margins. They are used to diversify portfolio, wherein low correlations with stocks or other asset classes makes it one of the product of choice. Maybe being in indices, what will happen is your overall risk gets reduced and diversified. If rather than being in the single commodity, you be in a basket of commodities. So that is always preferred. We saw the example with an Excel sheet there earlier. Bigger advantages, these products are all cash settled, so there is no tension of or moving towards tender period margin, delivery period margins. That is just taken off. You can do a lot of strategies for cash settled contracts. Plus, churning is quicker here with quick break even achievement, and to avoid a single commodity risk, a lot of trading strategies is possible. I've just given you a total picture of the story. We can do a lot of things. Even these indices are acting like benchmarks to different segments of the economy. Manufacturing segments, they are looking up to base metal indices, or energy segment looking up to the energy index. So it enables people to manage their physical transaction in a better way with keeping a benchmark in front of them. And second, they can also mitigate their risk using these products for companies who have exposure to complete segment of the products which are there in the index. Plus, cross margin benefits are reaped when you have some strategies between the underlying futures and the index futures in a particular percentage as signed and allowed by the regulators. So that is also available. Plus, people who deal here in these products will often be into trading, investment. You can look these products from jobbing point of view with quick churning, arbitraging, a lot of benefits, calendar spreads, from underlying futures to the index futures. So a lot of things could be done as far as the investing and trading in index derivatives is concerned. Plus, you can just go and our website, you on MCX, there are a lot of fact sheets, methodologies, FAQs, weights, its constituents, rollover calendar, to understand these products better. So this is where I stop today, and I respect the time, and we go ahead. Over to you, Chandrasekhar sir. I hope I have added some points over and above what you have already done and already been said by Vikram ji. So over to you, please.
Thank you, Vinit. Wonderful. I must compliment you for a comprehensive presentation with a lot of clarity. Wonderful. I'm truly delighted that you have joined this event on behalf of MCX. Yes, wonderful. Yes, I want to mention to the participants, those participants who have traded futures or even options would find this much less difficult to understand. But those who are probably not exposed to trading commodities, even futures, will probably find it a little tough to understand the nuances. But I can assure you, this is not rocket science. This is something, there'll be a lot of questions in your mind. Okay, I think you need to study more, attend our events in future, and over 1, 2, or 3 events, I'm sure a lot of clarity will emerge in your own understanding. Now let's go into the chat box and see, because I saw at least 2 questions. Perhaps Vikram can take this. Is it better to invest in commodity indices or commodity ETFs? What would be your advice, Vikram?
Yeah, sorry, sir.
Yeah, that's
Yeah.
fine. Okay. Is it better
Yeah.
to invest in commodity indices or commodity ETFs? What would be your advice?
So I think for a retail investor, the ETFs are always a better option for 3 reasons. First of all, let me take the example of the gold or the silver ETF. As a retail investor, you can buy 1 gram of, 1 unit or 1 gram of ETF, buy and sell without any impact cost, hardly any impact cost. Whereas if you were to buy physical gold or physical silver of 1 gram and then sell it in the market, then you would have a huge, I don't know, 3, 4, 5, 10% as the impact cost. So the commodity ETFs have been one of the best inventions of the financial sector in the past 2, 3 decades, but of the century, you can say, basically, which is we are in 22 years down this century. And that is one thing. Secondly, there is freedom from GST. So you can, when you buy and sell physical gold or silver or copper or any other commodity, there is a implication of GST involved in that. Whereas ETF units, you can buy and sell any number of times. There is no GST implication in that. Last but not the least, the ETFs are, backed by physical or whatever futures or whatever it is. Let's talk about, to make it slightly more, understandable for the people for this forum. Let's talk about gold ETF or silver ETF. Each penny or each rupee that we raise from you is backed by 100% by physical gold or silver, which is of the highest quality. As per the SEBI mandate, it has to be LBMA good delivery or better if you can get it. And so you are, and there is it's got lots of ears and eyes on it. There is regulator which is keeping an eye on the AUM and the fund. There is the custodian which is appointed by us, which is also regulated by SEBI, and of course the AMC. So there are a lot of multiple bodies involved besides the regulator involved in the safety and fidelity of your fund. So in a way, because the Indian mutual fund ecosystem is so strict, thanks to SEBI, you can be assured of safety and security of your stuff. So the answer is yes, it's better to buy, for retail investors, to buy ETFs vis-a-vis the futures.
But one question I have, Vikram, we know we have gold ETF, we have silver ETF. What are the other commodities where ETFs are available in India?
So we have only gold and silver.
Gold and silver, yeah. Therefore, if you are an investor in gold and silver, then if I have read Vikram's mind correctly, then ETFs are a better option. Whereas where there are no ETFs, for example, in energy products or in base metals, for example, then obviously you have the index, which is available for investment. Is that what you're saying?
Yeah, there's one more option available. There is hybrid funds which are permitted by SEBI, in which we have a hybrid fund. I manage that multi-asset fund in which we are also holding crude oil. At times we have held the metal dex also, and silver and gold and gas, all the commodities. So you can, if you're looking to something beyond gold and silver in exposure, you can also consider this multi-asset funds or hybrid funds, mutual funds.
All right. I think that thank you very much. Any thought from Vinit? You have a point to make in this. So which is better to invest, commodity indices or commodity ETFs? It's not that we are having a debate here, but whatever experts can share with the participants will always be helpful.
Sir, definitely, since I am representing exchange, so I might not digress from, saying that index are not better off. But yes, it purely depends on what kind of participants are looking these instruments as, for retail participants, definitely, they might, as Vikramji was saying, that cost is a bit, of concern, plus backing of the instrument by the products. But otherwise, we could also ponder maybe whether it would not be a pure retail investor. Through mutual funds, they definitely can benefit of having commodities in the portfolio, which the fund manager has already allocated or changed their views from time to time. But yes, definitely if they are too much into the analysis and they understand the market and they follow the principles of trading, so they can as well, they can look up to index derivatives as well, because they are not so expensive products, wherein I mentioned the churning is very quick. Definitely, that could also be taken into consideration. Yes.
Very good, very good.
So,
Thanks.
so sir, on to speak on MCX behalf, the moment SEBI permits us to launch ETFs on their indices, we'll be very happy to do it.
Right.
That is one thing. And secondly, I think, well, fortunately for us and unfortunately for, for the rest of the market, we have the tax advantage. When you're buying mutual funds, you get the tax benefit in that. So I think we hope that MCX and, the mutual fund industry can combine and, allow the industry to launch these indices, which are launched by, for instance, tomorrow, crude ETF is something which we have been speaking for a long time. India is, we import 85% of our crude.
Absolutely.
Why don't we have a crude ETF, and the underlying will be the crude contract or MCX. So I think the industry and the investors need to work together for these products.
Right. Only issue will be the infrastructure for storage, etc. But that will take care of itself in terms of the
so we will have we'll have the MCX futures contract at the underlying.
Right. Yeah. Perfect. I think we are actually coming close to the concluding this event, but there is one more question. Investors prefer investing in equity indices over commodity indices. How do we convince them that the commodity indices are a good opportunity? Any quick thoughts? Half a minute, 1 minute advice to the participants, Vikram?
So
and then I'll go to Vinit. Yeah.
See, to be honest, equities are much bigger market, but bonds are even bigger market. So if you see the hierarchy of the market, it is bonds, equities, and then everything else after that. But what you have to remember is that, from the country point of view, as I mentioned, that we are net short of many commodities. And as and when these commodities rise, it plays havoc with you, with the economy, with the inflation and all those things. And eventually it has effects on the bond market also, and it has the effect on equity market. Just to give you an example, the correlation between crude oil prices and inflation is about 60 to 70%. So, I'm not saying you go and buy crude futures tomorrow, not giving a buy call on that. But, if there are instruments available, you can think of doing that. So if not as a primary investment, they should be considered as a diversifier or a hedge.
Absolutely. Thank you very much. Vinit, very quickly, in half a minute or 1 minute, any final passing comments, parting comments from your side?
Yeah, I mean, I would like to just add on what Vikramji said is like, since those products are already available in equity side and commodities is showing its relevance, in these days with inflation and other things happening across the world. So why not also think this area as well, which is emerging? We are talking about e-vehicles and different kinds of industries are giving a big impulse to the market. So definitely commodities will be required. That availability and scarcity will definitely bring into demand and supply thing. So yes, definitely, why not also be in this area, and why to be in an indirect beneficiary, like bonds or equities.
Absolutely. I recently wrote an article, 5 mega trends that will drive commodity markets over the coming decades. Anyway, wonderful. Thank you very much. I want to thank Vikram for his participation. Thank Vinit for his participation. Good luck. God bless you all. I want to thank all the participants who joined us. I want to thank IMC's Anita Naik and the IT team for their tremendous efforts. We will keep informing all the participants about our future events. Do join these training programs, awareness programs. We try and educate investors as much as possible within the limitations of time available, and therefore we will conclude. All good things have to end, and therefore we will conclude this event for today. Good luck. God bless you all. Stay safe until we meet again. Thank you.
Good luck,
Thank
everybody.
you, everyone. Thanks a lot.
Thank you.
Good luck.